Now let's get back to investment income, some of that unearned income included in gross income. We have a few items here: realized capital gains, which we've talked about already, interest and dividends, I think everybody's familiar with, original issue discount on bonds, which we'll talk a little bit more about in just a second, rent and royalty income, annuities, which we'll talk a little bit more about, traditional IRA distributions, and pass-through income. This is a type of business income, and we'll talk about this in much more detail several weeks down the road. So first, let's talk about the original issue discount. As the name suggests, this is for new issues only, original issues. And that original issue discount is the difference between the purchase price and the redemption price at maturity. And that difference, let's say its maturity price is $100, purchase price is $75. So that $25 original issue discount must be amortized over the life of that bond, let's say 10 years, so that'd be $2.50 per year that you would need to include in income. Now, this is an exception to that pure cash basis method of accounting, where we say generally interest is not recognized until it's received. In these zero coupon bonds, you're not receiving interest. You don't get it until the end or until you cash out, but the interest must be included in income nonetheless. It's just one of those exceptions to the general rule. One of the exceptions to the exception is Series E or EE U.S. government bonds. I think many of us have dealt with those either personally or with clients. Those are a form of zero coupon bonds. You buy a bond for $25, they become $50, and you do not have to pick that interest up in income each year. The last thing I'll say about original issue discount, sometimes preparers will get a little bit lazy. Obviously, if it's a taxable bond, you need to pick that up in income. It's taxable. Sometimes with tax-exempt bonds, preparers will get a little bit lazy, particularly if it's a tax-exempt bond that is also tax-exempt for state purposes. They'll say, oh, it doesn't matter. It's not taxable for federal purposes. It's not taxable for state purposes. But it's important to remember on the page 1 of the Form 1040, you do have to report tax-exempt income, tax-exempt interest, and tax-exempt dividends. And those numbers are important if you have a client who is paying Medicare premiums. If you've studied that part of your financial planning course, you'll know the Medicare premium cost is indexed based on your modified adjusted gross income. So that's adjusted gross income plus your tax-exempt interest. Likewise, when we talk about how Social Security is taxed, which we'll be talking about very shortly, Social Security taxability takes into account tax-exempt interest earned as well. So the moral of the story is, unless you are extremely well versed in the tax law, you live it, you breathe it every day, and you have for a long time, always be sure to report what you are told to report, even if you think maybe it doesn't make a difference, because unless you can mentally tick off all the possible ramifications that tax-exempt interest may have, you could end up miscalculating something just by trying to take a shortcut. Okay, so that's original issue discounts. Let's talk next about annuities. So annuities can be non-qualified or qualified. Qualified are kind of in the retirement plan arena. We're going to focus here on non-qualified annuity contracts. In that case, you have a taxable and a tax-exempt component because you buy a contract for, let's say, $50,000. And at some point, either next month, if it's an immediate annuity, or 10 years, 20 years down the road, if it's a deferred annuity, you will start receiving monthly payments. When you do, part of that monthly payment is going to be a tax-free, tax-exempt return of that $50,000 that you put into the contract, and part of that is going to be earnings. Those earnings are always taxed as ordinary income, regardless of how that contract generates the income. And what I mean by that is a fixed annuity typically is just crediting a fixed rate of interest, and whether that's interest inside or outside an annuity, that would always be taxed at ordinary rates. But variable annuities will be indexed to the stock market. And even though your performance in your annuity and your earnings inside the annuity are based on dividends and realized and unrealized gains and losses, which realized gains and losses and qualified dividends would be taxed at a preferred rate because they're inside that annuity wrapper. When they come out to you as part of your annuity payment or your client's annuity payment, they're going to be taxed at ordinary income. So that is a tax adverse consequence of having a variable annuity. Now, that doesn't mean that annuities or variable annuities are never good. It doesn't mean that it's not the right tool for clients in certain situations, but it does mean that's one thing that you need to consider when you're making your evaluation from a holistic planning perspective. You need to consider the tax consequences of this annuity versus other types of arrangements to provide income during retirement. Most annuities are for a lifetime, but certain contracts can be a fixed period, say 10 or 20 years. If you have a lifetime annuity and there is still cost basis left inside the contract when the annuitant passes away, the annuity payments cease, and that remaining cost basis, it doesn't get refunded to the client. That actually goes to pay for people who live past their expected life expectancy. That cost basis is surrendered, forfeited, and it is just a miscellaneous itemized deduction. It's not a capital loss, it's not an ordinary loss, and many clients won't be able to take advantage of this itemized deduction provision. Another thing to keep in mind when you're evaluating the pros and cons of an annuity. Surrendering an annuity can have tax consequences. So maybe you have a new client who has existing annuities from another advisor, and you decide for the comprehensive plan that these don't make sense for that taxpayer. If you surrender, the client may have to pay income taxes on some of that surrender value. To the extent the surrender value represents premiums paid less the insurance charges, that would not be taxable. That would be your return of basis. But anything that represents inside value built up in the contract, that would be taxable as ordinary income. So when you're making that recommendation to surrender those annuities, not exchange them, because that's a different mechanism, which we'll talk about in another week. But if we're talking about purely surrendering and getting the check, be sure that you have taken into account any taxes that would be due on part or all of that surrender value. And then finally, although these non-qualified annuities are not considered retirement plans, they do have some retirement plan like consequences. So if there's an early distribution, if the annuitant is under 59 and a half, there's a 10% penalty in addition to the income tax consequences. And they're just like if you take distributions early from qualified retirement plans, there are different exceptions. For instance, substantially equal periodic payments that can help a client avoid the 10% penalty, but just know that it is there. We've talked about some investment income that is included in your taxable income. Now let's talk about a few exclusions. Muni bond interest, which we've talked about, I think, extensively. Those life insurance proceeds, so a death benefit is almost never taxable. If you purchase the life insurance contract, it can be taxable, but life insurance beneficiaries typically will not pay tax on those life insurance proceeds. Most of the cash surrender value, though not all, would not be taxable. Roth IRA distributions, if you've met the requirements, I guess we would call those qualified distributions, and certain income used for qualified education expenses.